Hello, welcome to section 3 of the webinar. In this video, we will cover the following topics. First, we will cover the general rules of deduction. 2. Pre-commencement expenses. 3. Interest expenses. 4. Medical expenses. 5. Section 14, N expenses, and lastly, tax deductions or allowances under the Enterprise Innovation Scheme, or EIS for short. As usual, you can jump to any section that interests you by clicking the timestamps in the description box below. You can also download the presentation slides available in the description box below. These slides include useful links for additional resources and information. Deductibility of expenses. For any expense to qualify for tax deduction, it must meet these conditions. First, expenses are wholly and exclusively incurred for producing income, which means it must be directly business-related and not personal. Second, expenses are revenue in nature. This will be the normal day-to-day operating expenses, like rent and salaries, not capital expenditure. Third, expenses must actually be incurred and not estimates or provisions. Fourth, expenses are not prohibited under Section 15 of the Income Tax Act, such as expenses like private car costs are specifically disallowed, even if business-related. I would also like to elaborate more on the difference between capital and revenue expenses. Revenue expenses are day-to-day operational costs, like salaries, rent, and utilities, that are fully deductible in the year incurred. Capital expenses, on the other hand, are investments in long-term assets like equipment or property that provide lasting value and must be depreciated over time. Let me give you some clear examples of expenses that are not deductible. First, private and domestic expenses, for examples directors' personal entertainment or vacation costs. Even if paid through the company, they're not deductible because they're personal. Second, capital expenditure, expenses for acquiring assets or setting up business, like buying machinery or incorporation costs. IRAS website has a long list of expenses, which are deductible and non-deductible, which you can refer to for further details. As some of you here might be handling newly incorporated companies, this section on pre-commencement expenses would be relevant to you. Generally, pre-commencement expenses are not tax-deductible, as they are incurred prior to the production of income and generating revenue. However, to assist businesses with their development, we will allow companies to claim tax deductions so long as their revenue expenses were incurred in the same financial year in which it earns its first dollar. Revenue expenses incurred 1 year before the deemed commencement date are also deductible. Let's look at the next slide to illustrate what this means. In this example, the company has a financial year ending 31st December. Company earned its first dollar of business receipt on 1st September 2024. Deemed date of commencement will be 1st January 2024. As such, revenue expenses incurred from 1st January to 31st December 2024 will be deductible, as business is treated as having commenced on 1st January 2024. Revenue expenses incurred from January 1st to December 31st, 2023 will also be treated as incurred on January 1st, 2024 and deductible in YA 2025, as these expenses were incurred 1 year before the deemed date of commencement. Let's move on to the deductibility of interest expenses. Deductibility of interest expense is dependent on the purpose of the loan. If the loan is used to purchase income-producing assets like trading stock or factories for manufacturing goods, the interest is deductible because these assets generate revenue from sales. However, interest is not deductible if the loan is used to purchase non-income-producing assets, such as vacant investment properties, dividend-free shares, or securities, or provides interest-free loans to related parties, as these don't generate income. There might be situations where a company may have taken out a loan, which is used for different purposes, and the company is unable to directly attribute the interest expense to income and non-income producing assets. In such cases, the company can apply the total asset method to compute the common interest expenses to be disallowed for tax deduction. Below is the formula you can adopt. Okay, let's move on to deductibility of medical expenses. Companies that incur medical expenses for its employees will be allowed tax deduction based on either 1% of total employee remuneration or 2% if the company meets the conditions under 1. PMBS or TMIS scheme, or 2. Provided employees with inpatient medical insurance benefits in the form of portable medical shield plans. Total remuneration includes employees' salaries, allowances and bonuses, directors' executive remuneration and CPF contributions, and excludes the following expenses. In this example, the total remuneration is $100,000 and the medical expenses incurred is $2,500. Under the 1% cap, the amount of deductible expenses is $1,000. Hence, the amount on non-deductible expenses will be $1,500, which is $2,500 minus $1,000. Under the 2% cap, the amount of deductible expenses is $2,000. Hence, the amount on non-deductible expenses will only be $500, which is $2,500 minus $2,000. Okay, let's move on to Section 14N, or Renovation and Refurbishment Expenses. Here are some examples of qualifying Section 14N expenses. Also, with effect from YA 2025, companies can claim design and professional fees. Please note that these expenditures should not be included for Section 14N claim. Also, if you did not fully utilize Section 14N for the current YA, it will form part of adjusted loss and you are able to carry forward and carry back. It is also available for transfer under the group relief system. So, how do you claim Section 14N? There are two concepts that you need to understand. First is the capping concept. For every 3 consecutive YA, there is a $300,000 cap. Next is the claiming concept. You have the option of claiming each YA over 3 years or 1 year. To illustrate this, we will go through an example later. To reduce compliance burden, the relevant 3-year period that is used to determine the Section 14N expenditure cap will be fixed, with the first fixed 3-year period being from YA 2025 to YA 2027. Also, from YA 2025 onwards, you can choose the 1-year write-off option instead of only 3 years option. Let's go through an example to show how the Section 14N deduction works. A company incurred Section 14N expenses in YA 2025 of $120,000. The company is expected to incur $150,000 and $90,000 of Section 14N expenses in YA 2026 and YA 2027, respectively. The company would like to take advantage of the accelerated claim over 1 year instead of 3 years. So first, let's do the capping. The allowable Section 14N expenses are $120,000 in YA 2025, $150,000 in YA 2026. For YA 2027, we can only claim $30,000 even though we incurred $90,000. This is because we have exceeded the overall cap of $300,000. After we have determined the capping amount, we can now move on to the claiming, since the company would like to claim the Section 14N expenses over 1 year. Hence, we can claim the full qualifying amount in the respective YAs. Next, let's move on to this section on Enterprise Innovation Scheme. This scheme was introduced not too long ago. Basically, businesses that engage in research and development, or R&D, innovation and capability development activities may benefit from the enhanced or new tax deductions and/or allowances on qualifying expenditure incurred during the basis period for YA 2024 to YA 2028. These are the 5 qualifying activities. From YA 2024 to YA 2028, business are allowed to claim either 1. 400% tax deductions or allowances on up to $400,000 qualifying expenditure per year, or 2. Option to convert up to $100,000 of qualifying expenditure into cash payout at a rate of 20%, that is maximum $20,000 in cash payout per YA. To summarize, here is the qualifying conditions if the business wished to claim enhanced tax deductions or allowances or cash payout. Please bear in mind that for the cash payout, the business needs to ensure that it meets the 3 full-time local employee condition. That is, make CPF contributions for at least 6 months during the basis period of the qualifying YA. All right, that is the end of this section. In the next section, we will be covering on capital allowances, utilization of unabsorbed items, and CIT rebate. See you then.